This video will be a recap of your assumed knowledge from Audit and Assurance exam. To begin with, if you remember from our earlier study, misstatements including emissions are considered to be material if they individually or in aggregate could be expected to influence the economic decisions of users taken on the basis of the financial statements. So this is something that we know already from our earlier studies. We're now going to focus on the revision of the concept of materiality. Remember, at this stage, which is the planning stage, the auditor has to determine initial materiality, which can be revised as the audit progresses. Also important to remember that assessment of what is material is ultimately the auditor's professional judgment. This is affected by the auditor's perception of the financial information needs of users, along with the perceived level of risk that they have concluded based on the risk assessment that they have done. Again, if the risk is high, then materiality is going to be lower. So when there's a higher chance of fraud and error, then even small amounts are going to become material. Please remember, we need to start off with determining materiality is by amount. So materiality is often calculated using benchmarks such as the ones that you see on the screen. You could have 5% of profit before tax, 1% of total assets, or 0.5% of revenue. These values are useful as a starting point for assessing materiality. These are the ones that we would expect you to use for the AAA exam as well. They also need to make a list of items which are material by nature. So, for example, related party transactions, transactions with directors, etc., your bank balance, which is an account balance, any area which affects debt covenants. So, for example, for long-term loan, if there's a debt covenant attached to inventory, then inventory becomes material by nature. Material by nature basically means regardless of the amount, even if it's $10, this is a material area and we will need to focus on this area particularly. Areas which have had recurring errors in the past as well. So maybe it's not material by amount, say payroll expense for the year, but because this has had repeated errors in the past, it becomes material by nature. Any one-off items, non-recurring items, it would be material by nature. Items which could affect statutory requirements, they will automatically become material by nature. At the opinion stage, there would be some items which are material by impact. For example, although the misstatement is, say, only $500, it'll convert a profit into a loss. So it becomes material by impact. But currently, at the initial stage, the first two is what we're going to be focusing on. As auditors, we also need to set performance materiality for individual classes of transactions and account balances. So as auditors, this is important to remember that performance materiality is always going to be lower than the overall materiality level. So for example, if for the P&L, my materiality is 500, then for an individual class of transaction like revenue, the performance materiality will always be lower than 500. The aim of performance materiality is to reduce the risk that the total of errors in balances or transaction does not in total exceed overall materiality, right? So again, performance materiality is set primarily for risky areas. We need to evaluate the scope as well. This includes making sure we understand where the locations and branches are so we can get the information from those locations, branches, making sure they're using the right financial reporting framework, finding out if there are any industry-specific regulations that increase the scope of our work, evaluating whether we're going to use experts in any part of audit. Are we going to be using computer-aided audit techniques like test data or audit software or data analytics in our evaluation or in our audit? Are we going to be using the work of internal auditors? Has anything been outsourced by the client, which means we might have to use the work of service organization and their auditors? And if it's a group audit, this would have separate implications that are going to be covered in a separate video entirely. At the planning stage, we're going to be setting deadlines as well for reporting, for meetings with those charged with governance, any letters, communication that's going to take place, team meetings, etc. Based on my evaluation to date, we need to decide a direction. If remember, you've already understood the controls. We could either have an approach or a direction where we're going to first test the internal control and then decide on extent of substantive testing. Or if you feel, for example, this is an owner-managed business with absolutely no internal control, so there's no point in wasting too much time on internal control, we could be going for a mainly substantive approach as well. If you remember from your earlier studies of quality control, direction is set by the engagement partner at the planning stage in the team meeting, where from engagement partner till the audit junior, everyone has to be there. Something which has come up in the past, and this is an additional topic, easy marks if this comes up. For initial audit engagement, so this is the first time your firm is conducting an audit, there are 4 main things you need to keep in mind. You would have performed procedures at the acceptance stage that have been covered in a separate video. You would have communicated with the outgoing auditor, again covered separately. But at the planning stage, understand you'd need to plan additional procedures on opening balances, and you'd have to spend a bit more time in understanding the client. That was covered in a separate video, because this is the first time you're auditing this client and you would not have the in-depth knowledge that you need to actually assess risk properly.